Most of us are taught that the path to wealth is about one of two things, either earning a massive salary or picking the next big explosive stock. But what if the real secret isn't what you own, but how you own it? The difference between an average portfolio and a top 1% portfolio, well, it's less about some kind of magic and a lot more about math and, most importantly, structure.
All right, so let's map out exactly how we're going to break this down. First, we'll dig into this fundamental idea I call the allocation gap. It's the core difference in thinking. Then, we're going to travel through 3 distinct phases of a financial life, starting with wealth acceleration in your 20s, moving to capital formation in your 30s and 40s, and then landing on dynasty building in your 50s and beyond. And to wrap it all up, we'll uncover the philosophy of capital that really powers this entire system.
So here's the most crucial point, the one thing to really get. The gap between the average investor and the wealthy isn't just about the amount of money they have. It's the architecture. It's the actual system they built for their capital to operate within. And this, right here, gets to the absolute heart of it. On one side, you've got the typical approach, which, let's be honest, it looks like a financial junk drawer. There's a 401k from an old job, some savings sitting in a low-interest account, maybe a few stocks someone bought on a hot tip. It's just a random collection of assets, right? Accumulated over time with no real plan. But on the other side, you see the wealthy's approach. It's a financial machine. Every single asset is a specific gear with a specific purpose, and they all work together to generate wealth.
At the end of the day, pretty much everyone is working with the same basic building blocks. We're talking about stocks, real estate, and cash. The difference isn't the ingredients, it's the recipe. This is the whole game of asset allocation, deciding precisely how much of your capital goes into each one of these buckets.
And this is really where most people get it completely backward. They obsess over finding that one perfect stock, right? That one tiny little gear. But study after study shows the same thing. Over 90% of your long-term returns don't come from picking individual winners. They come from your overall asset allocation. They come from the design of the machine itself.
Okay, so let's move into phase 1 and see how this machine gets built. It's in your 20s that the financial paths of the average person and the future top 1% really start to diverge. And it all begins with how they view their single greatest asset, which, by the way, probably isn't what you think it is.
So, for the average person in their 20s, safety is the name of the game. The data shows they hold over 30% of their entire net worth in cash. And look, while that might feel secure, that money is actively losing value. It's just sitting on the sidelines, getting eaten away by inflation every single day. It's a slow, silent drain on their financial future.
The wealthy, on the other hand, they have a completely different perspective. They understand that their biggest asset in their 20s isn't the cash in their bank account. No, it's their human capital. It's their skills, their knowledge, their network, their ability to earn more money in the future. Their goal isn't to hoard the little cash they have, it's to invest in themselves to absolutely maximize their future income. So think about it this way. A software engineer who spends their evenings learning a new coding language isn't just killing time, they're investing in their human capital.
So how do they actually put this into practice? Well, first, they invest in themselves. They acquire high-income skills that can double, even triple their earning potential. Second, they go after equity, ownership, often in the company they work for, or even better, a company they start themselves. And third, they concentrate their investments in high-growth assets. See, they're not afraid of volatility because they have a very long time horizon to recover from any dips, and their growing income can easily replace any losses along the way.
Okay, now we're entering the 30s and 40s. This is the capital formation phase. And this is where the wealth gap doesn't just widen, it explodes. And it all comes down to a fundamental disagreement about the role of a house.
For the average household, somewhere between 60 and 70% of their entire net worth gets locked up in their primary home. They become what we call house-rich, cash-poor. They own this really expensive asset, but it's an asset that actively takes money out of their pocket every single month through mortgages, taxes, and all the upkeep.
Now contrast that with the wealthy. For them, a primary residence is a lifestyle choice. It's not an investment. It rarely makes up more than 10 or 15% of their net worth. Why? Because the rest of their capital is free to be deployed into assets that actually put money in their pocket. Things like rental properties, dividend-paying stocks, private businesses. They own assets that pay them, not assets they have to pay for. And here's the proof. This isn't just a theory. This is from Federal Reserve data. So what is the single largest component of wealth for the top 1%? It's not stocks. It's not even real estate. It's business equity.
They prioritize owning pieces of income-producing businesses above everything else.
This brings us to the final phase, and this is where the goals diverge completely. The average person is playing defense. They're just trying not to run out of money. The wealthy, though, they're playing for perpetuity. They're building a system that is designed to outlive them.
So as retirement gets closer, the average investor shifts heavily into safe assets, things like bonds and fixed income. The goal here is capital preservation. But here's the problem. These low-yield assets often fail to even outpace inflation, which means their lifestyle and purchasing power slowly erode over time. Their nest egg is actually shrinking in real terms.
The wealthy don't retire from investing. Instead, they shift their focus. They start optimizing their financial machine for income, tax efficiency, and multi-generational transfer. They build what you could call a dynasty system. It starts with a central core of diversified income-producing assets. This core is then protected from things like lawsuits and taxes using legal structures like trusts and LLCs. The income generated by these protected assets is then used to fund their lifestyle, new investments, and their heirs, creating a self-sustaining loop that can literally last for generations.
So let's zoom out for a minute from the specific phases and look at the underlying philosophy here. This is the real code. It's the difference between viewing your money as something to be stored in a container versus something to be deployed as part of a system.
So here's a look at what a modern high net worth portfolio actually looks like based on recent data. Public stocks or equities are still the engine of growth, sitting at around 47%. But just look at the diversification. You've got significant chunks in real estate and private companies. And what's really interesting here is the surprisingly small allocation to traditional cash and bonds. See, this is a portfolio that's designed to work, not just sit there.
And if we dive a little deeper, you start to see the strategy. Equities provide the growth, sure, but for income, they're not settling for the low yields of government bonds anymore. They're moving into alternatives like private credit, that's loaning money directly to businesses, and direct lending, all to generate much higher returns. This is what keeps the entire system humming and generating cash flow.
And this right here, this is the key mindset shift. The average person sees money as a resource to be stored in a big savings container. The wealthy, however, see their capital as a team of employees. Every single dollar is given a specific job to do. Some are tasked with growth, some with generating income, some with providing protection, and some with building a legacy. And this completely changes the fundamental question you ask. Instead of asking, what stock should I buy? They ask, what job does my money need to do for me right now? And once that job is defined, selecting the right asset for it becomes a logical next step, not some kind of speculative guess. So, to bring it all together, an average portfolio is a static container. You put money in, and you just hope it grows. A wealthy portfolio is a dynamic financial ecosystem. Each part supports the others, generating cash flow, minimizing taxes, and creating a structure that is both resilient and self-sustaining.
Ultimately, the journey to real wealth isn't a treasure hunt for the next big thing. It's a process of architectural design. It's about deliberately engineering a system that works for you at every single stage of your life. So I'll just leave you with this one question to think about. When you look at your own assets, what do you see? Do you see a random collection of things you've acquired over time? Or do you see a system where every single piece has a purpose and is working towards a specific goal? The answer to that question, well, it could change everything.